Today we're covering a non-performing senior lien that was resolved through a modification agreement. NPL, non-performing loan, SR, senior position lien, and MOD, we resolved this through a loan modification with our borrower. So to look behind the scenes here and see exactly what we were dealing with, we were secured by a single family residential property. The taxes senior to us were current, and we have full equity coverage in the deal. So looking a little bit deeper into that, we had $61,000 balance of the property. This was the amount the home was worth, minus the taxes, which were zero. So it leaves us $61,000 of equity, securing our principal balance on our senior lien of $28,455.43. You can see here the calculation. Equity is just fair market value minus the tax balance, and equity coverage is the equity divided by the unpaid principal balance. So we can see because that is greater than 1, we have full equity coverage in the deal. From the borrower's perspective, the CLTV, or the first lien plus all the other liens on the property, in this case there was only the senior lien and the taxes owed, divided by the fair market value, is less than 1. So from the borrower's perspective as well, it is a full equity deal. So let's look into the modification that we completed here. Well, first off, we paid $6,425 for the loan, which was just 22% of the balance owed. Now, this is quite a good deal. It was a couple of years ago when pricing was a little bit more favorable, and it was purchased as part of a package deal. That being said, we negotiated a modification agreement of $252.64. So if we take the modification payment, annualize it, just multiply it by 12, 252.64 times 12, divided by our cost basis of $6,425, you can see that our annual return, if we held this modified loan, was 47.19%. That means that in just more than 2 years, we'd recoup all of our investment into this asset and then continue to collect those $250 monthly payments going forward. In this case, though, we sold this modified loan for $14,000 after collecting 4 of those $252 monthly payments. So we'll break down how that looks in the full internal rate of return in just a minute. First, though, I want to talk about the borrower story, break down a little bit more about what happened on this deal. So to get started, we modified this loan 3 months after buying it as a non-performing debt. We negotiated a deal with the daughter of the borrower. The borrower in this case was over 80 years old. He was actually 89 and suffering from dementia, and it was pretty difficult to communicate with him. So the borrower took it upon herself to get this resolved for her father. The property was worth much less than expected. Although we calculated it around $61,000 when we purchased the loan, the daughter actually owned a comparable rental property down the street that she wasn't able to sell for 15 grand. So now we've re-established our understanding of the value of the neighborhood, considering it less than $20,000 for this property. They were actually willing to get a modification done, though, around $200 per month. And they were going to possibly increase it to $400 per month over time. But instead, we were able to negotiate a fixed rate modification at that $252 per month figure and got that cash flow started just 3 months after acquiring the loan. Now, that fixed rate loan modification then was what we sold to an investor going forward. So we can look at the breakdown of how that actually pencils for us by calculating the potential internal rate of return. And this is actually the actual internal rate of return in this case. So a back of the napkin way to calculate this is taking the total amount collected minus the cost basis divided by the cost basis. So that's just your ROI, but then putting that in terms of the time value of money by dividing by the amount of time it takes. Months to exit divided by 12. So in this case, we sold it for $14,000, but we collected just over $1,000 in monthly payments. So that gives us a $15,000 total amount collected minus our $6,425 of cost basis divided by our cost basis to give us a 134% return on investment. However, because we did this in less than a year, in 7 months, remember we resolved it in 3 months, we collected 4 months of payments, then we sold it. That means that our denominator of this final calculation for internal rate of return is 0.583, which means our internal rate of return on the deal was over 200%. So this is really important to calculate your IRR. The back of the napkin way is pretty simple to just pencil in and see where you're going to fall. But to calculate this in more detail, use XIRR in Excel. If you check out the FIXnotes blog, we have some case studies available on the blog which show you how to calculate in Excel using XIRR to get a much more sophisticated, detailed internal rate of return for irregular cash flows like this, We're collecting $252 per month for several months and then collecting that $14,000 lump sum when we sell the deal. So let's talk about a few takeaways on this one just to drive it home. And the first takeaway here is that the power of attorney can be very, very helpful for older borrowers. Even when they're not in a dementia situation like this, a tech-savvy younger person can be instrumental in getting a quick loan modification done. Just responding via email alone is a super useful thing to deal with when you're working with borrowers. I have to sometimes mail borrowers letters. If they want to see the modification agreement on paper, they maybe don't have a printer and they don't use email. And it just slows down the process waiting for the mail to be delivered and sent back to you. And of course, if that's the way the borrower intends to communicate, that's the best you've got going. So definitely work with them in their preferred format. But if you can email, that's definitely gonna be the quickest, most fast turnaround to get those signed modification agreements back. Another one here, another takeaway for you, even with a potentially tentative equity situation, in this case, we thought it was a full equity deal, but then when we looked at the property value being less than $20,000, maybe even only a $15,000 home with the balance being $28,000, we were actually in a negative equity situation. But because of emotional equity, the borrower's family did want to keep the property. So getting that loan modification done is going to be the best possible exit for everybody. The borrowers get to keep their property and bring the loan current, and we don't have to take back a property that maybe is worth less than the balance owed. And then finally, the note buyer on this deal bought this loan at a 19% annual return, getting $14,000 of invested capital out to receive $252 per month with about a $20 monthly servicing fee, works out to around 19% of their annual return. So they're going to recoup their funds in just over 5 years on the deal and then have 15 more years worth of payments on this 20-year term. So in this case, a package deal offered a better yield for the note investor. They bought some non-performing loans as well with this package that included this reperforming loan. So they got pretty great return. Now in the secondary market, a non-performing first lien that has been modified, we call it a reperforming loan, can be worth around 15% yields. So they got a better yield because of the package deal and because of the tentative equity situation on this one. So that wraps up today's case study. Tune in next month for another one or our next Wednesday's video to learn more about the secondary mortgage market. I'll see you in the comments below.